Hey everybody, welcome to the 40 Finance channel. My name's Jeff Beers. Today I've pulled out 5 growth stocks that have 0 long-term debt on their balance sheets. It's very hard to operate a growth company with huge growth goals and not run long-term debt of some kind. But these 5 companies here have done it. So let's jump in and see what they're all about. Okay, first on our list today is Align Technology. And Align Technology are the makers behind Invisalign braces, which you've obviously probably seen in a lot of different places. And they're really turning the entire braces industry upside down on its head, right? They're reinventing a very expensive, old school dental practice, and it's paying off. They're growing at an insane rate. Right now, the stock has not recovered from a dip in October. It's running a P/E ratio of 70, but it has made some gains since the drop in October. We're currently at $325 for a stock price. And as I mentioned, no long-term debt with this company. You got a shrinking forward PE of around 45 and total cash on hand $774 million. So this is a company that still has levers to pull when it comes to growth. Now, I'm not saying that they should jump into long-term debt with bonds and loans and things like that, but what is comforting from a growth situation is they still have levers to pull, right? They have some cash on hand. They already have a successful product. So pushing these things at the right time could mean even more explosive growth in the near future. Okay, number 2 on the list is Chipotle. And Chipotle has been a very interesting stock. There's a lot of opportunity to buy Chipotle as recently as last year, right? In and around May through October, because they had some health scares in terms of some of their preparation practices. People got sick from tainted vegetables or something like that, and only in certain locations. And so Chipotle took an absolute beating last year, but you see now, it's almost scary how much they've jumped, and we're up to $700, $708. Today's P/E ratio is 96, but just like Invisalign, we have a shrinking forward PE dropping all the way to 42 is what it's anticipated at. The cash on hand right now is $735 million. And what I think the best case for Chipotle is not only expanding out to perhaps foreign markets, but they also have an opportunity with so many restaurants to improve their margins slightly, which can be a huge boost to the bottom line. I'm looking for good things from Chipotle. I don't know if I'm buying it at $700, but come the next dip, if you're interested in a stock like this, you might be able to shave another 100 or so off, and maybe that's enough to jump in. All right, next stock up is Skyworks Solutions. Skyworks Solutions makes semiconductors, most notably for a lot of the audio features in popular cell phones. They believe they have a pretty big contract with both Samsung and Apple. This is a company that has a track record of success. Unfortunately, the semiconductor market ebbs and flows on sales of cell phones, so you're going to have some dips. Right now, they've taken a minor move back to $78. They were as high as $100 last year, so there's definitely some play in there to make money if you can predict the next buying cycle for semiconductors, which is honestly, it's probably the 5G rollout across America. But since we are in the semiconductor industry with Skyworks, you have a very low P/E ratio of 13. Once again, you got a shrinking forward PE heading down to 1060. And cash on hand, very close to $1 billion. They got $957 million on tap. So it's sort of interesting to think about Skyworks Solutions from a growth standpoint. So on one hand, they could invent new products, they could improve existing products, But at the end of the day, they really need the cell phone market to turn over so that they can get more chips into more new phones, because as soon as the chips are planted, as soon as the manufacturers buy the order, they're not coming back till those phones are gone. So the growth in Skyworks Solutions is growth in units with mobile phones. And so that's definitely something you have to pay attention to. On the bright side, particularly from a worldwide perspective, mobile phone growth will continue. Maybe not as much in the United States because penetration is so high, but you still have dozens and dozens of countries that still don't have internet access for the majority of their folks. So there's a lot of units to be sold. You just have to wait for the right time to jump in. Okay, next up is a video game maker, TakeTwo Interactive Software. TakeTwo Interactive Software, they make a lot of popular titles for your Xbox, PlayStations, things like that. Grand Theft Auto, I believe they make the Red Death Redemption that has been popular with the youth over the past year. You also have like NBA 2K, things like that. Bottom line, this is an unbelievable company for a video game maker. And I don't think a lot of people understand just how strong of a company it is. It's hard in video games because there's a ton of ebbs and flows. It's a big time popularity contest based on what your latest titles are. TakeTwo Interactive has followed this cycle of down, down, down with the rest of the video game industry. They've popped up a little bit this year, but they're still only at $107. That is a PE of 37, and the forward PE for this company comes in under 20. So if you're following the video game industry and you can time things just right, this is a really attractive buying price. And no long-term debt, as we've already mentioned. And perhaps the biggest call out here for TakeTwo Interactive, they have a $1.57 billion in cash on hand right now. You think about video games and you think about a world of acquisitions and you wonder what's going to happen with Google and their cloud-based video game platform. Certainly there'll be dozens of others that spin up in the cloud as well. All those people need content, okay? And you're not going to buy out TakeTwo Interactive very easily, okay? They have a solid balance sheet, and if they can keep trucking along and making popular titles, they're in as good a position as anybody to reap the rewards of the next generation of video games. All right, last one here. I went with the popular one just to wrap up. Facebook. So Facebook has zero long-term debt. They have a PE ratio of 27 right now. The forward PE drops to 20 based on their anticipated earnings. We have a stock that's been over 200 very recently, sort of followed the ups and downs of the market. We're at 186 right now. And obviously, the reason Facebook is at this price point is because of the privacy concerns, right? And when's the next time the government's going to get involved? They just cannot shake the negative news. And a lot of it, in my opinion, is just opinion. It's a lot of people on mass media who are sharing what they think of Facebook, and that's great. You know, I live in the camp of, get the hell off it if you don't like it, right? Turn off your Gmail if you don't like Google. Get off Facebook if you don't like Google or Facebook, right? So that's where I stand. That's just one opinion, but I wish the tired story of what happens to Facebook in the era of privacy just ends. And as investors, you just have to make your own decision. The one thing I'll call out about Facebook's balance sheet that's a little odd is under immediate debt, you'll see that there's about $7 billion listed under immediate debt. That is a number they put on the balance sheet for in anticipation of the fine they will likely get from Europe and maybe even some in the US for fines related to privacy issues. So while it sits in a little bit of an odd spot, it's not under long-term debt, it's under current debt, or current liabilities. That's all planned out by accountants. Basically what they're saying is, hey, we see this coming, and just to let you know, we've got it covered. and we'll put it in this line item right here. And if you're worried about Facebook and you're worried about them going broke, their cash on hand is a staggering $45 billion, okay? $45 billion cash on hand. $6 billion fine sucks, but it's not gonna send them over the edge, right? So Facebook as a company, regardless of your opinion of them, they are in very good financial shape, and they have a lot of room to run in terms of acquisitions, new features, and any sort of other lever they want to pull to increase revenues. All right, guys, so those are my 5 hand-picked growth stocks with no long-term debt. If you haven't yet, please subscribe to the channel. I appreciate your support. We'll see you on the next video.